Good afternoon, everybody.
Good afternoon. Happy summer.
Hello, everyone.
Somehow well, I guess it's three of the four of us, but we're all together and not running around trying to find our kids and where they are at camps right now.
I realized that our camp pickup was at 3 p.m. And so we had to do an early pickup. I
Ah,
feel bad because Elsie was making cannolis, and who doesn't love a cannoli? I definitely do. And she didn't get to finish her cannoli and eat it.
ah,
Oh, that's
or
so
bring it home
sad.
for you to try, right?
I know, but she said that they're going to send all the recipes home, so we'll see.
All right. Well,
We'll
I
see if we'll
expect
be
some
able
in
to
the
do that.
office. I want a different version too, maybe like a pistachio version.
You can't go wrong. Chocolate chips are probably going to be my favorite.
Yeah, true. Classics are usually the best.
Yeah.
So.
So let's see here. If we're gonna get a notification about our sound checks, we got 11.
We got the sound check. I think we're all
Sound
good.
check is all
The
good.
sound check is
Ready to
all
go.
good. So we are good to go. I wanted to welcome everybody to the webinar. I'm Skylar Englehart, and I'm one of the private wealth advisors here at Armstrong Dixon, and I'm happy that you're able to join us today, and I look forward to diving into the topics that we have prepared for you. I hope everybody's summer is off to a great start. We're about halfway through the year, which is a good time to reset and refocus, and your financial plan should be no different. We're going to be walking through some key areas to revisit opportunities for growth and to stay aligned with your long-term goals. Um, I wanted to remind everyone that we welcome live feedback during the webinar, and at any time, feel free to email us at info@armstrongdixon.com. Jenna will be monitoring the emails throughout the webinar, and we'll try to answer everything that comes in. If you have any connectivity issues at this time, we recommend fully exiting and re-entering the webinar first. On today's webinar, I'm joined by Gregory Armstrong and Navarone Simpson, as well as uh, Magdala Adeleke. I hope I'm saying
You
this
got it.
correctly, Magdala. I did it. We practiced. We're all certified financial planner professionals here, and Magdala is new to the team, so I wanted to give her a few minutes to tell everybody a little bit about herself.
Thanks, Skylar. Hi, everyone. I'm so excited to be here with you. As Skylar said, my name is Magdala Adeleke, and I've been here for just about 2 months. Tomorrow will be officially 2 months, and it feels a lot longer in a good way. I feel like I'm part of the family. I've gotten to know everyone really well, so it's really been an exciting opportunity for me to be here. I look forward to getting to know you, especially the ones that I'll be working with. So, a little bit about myself. In addition to being a financial planner, I'm also a divorce financial analyst. So, we are the people that you would talk to help you understand the financial side of a divorce to make a more informed decision. We know that this is not an area of expertise that, most people want to deal with, but if it happens, then it's great to have someone that could help you navigate that tough transition. But one of the designations that I have that I'm most passionate about is being a financial therapist. You may not have heard of this, but it's becoming very popular, and I'm sure you've heard of money mindset. So it's similar to that, right? So financial therapy combines financial planning with psychology to help individuals understand how their experiences, beliefs, and emotions around money impact their financial decisions, right? So it's like therapy around your money issues, and we all have them, right? But it's really great to understand where our behaviors and our habits come from, and everything comes from childhood. So whatever experiences you had in your childhood in your life, it really impacts the way that you view money and behave around it. And one of the things that attracted me to Armstrong Dixon is that the relationship is at the core of what we do here, right? So I know your planner knows so much about you, and they don't only focus on the numbers, but on the relationship, getting to know you, your families, what's important to you, and that people-centered approach is really important to me. And I'm glad to be a part of a company that focuses on that. So, on a personal level, I live in Howard County. I have two crazy boys. They're into soccer and Rubik's Cube and eating a lot. Like I feel like I'm getting eaten out of my house right now, and I'm not sure what to do about it. So if I'm not at the grocery store, you'll find me on the soccer field and listening to the constant clicks of a Rubik's Cube. If you haven't experienced that, it's an interesting experience. So to keep
Don't they enter into competitions for
they
that?
do, they do. They have competition, and those competitions are interesting. Because can you imagine hundreds of kids like solving Rubik's Cube for like 8 hours? It's a
Right,
lot.
right.
Yeah, but it's a pretty cool activity. I prefer that over the screens for sure. And to zen myself out, I enjoy traveling, reading, food. So maybe they got eating from me and just spending time with family and friends. So I look forward to getting to know you and working with you in this amazing team.
Magdala,
Nice.
thank you so much for sharing a little bit about yourself. We are so glad to have you here at Armstrong Dixon.
Thank you.
And we will have a guest speaker on today's webinar. Ken Bennick with Apex Home Loans will be joining us to share insights on today's mortgage market financing strategies and how homeowner decisions can support long-term financial planning. So, to kind of to kick things off, wanted to visit with Greg here, we're gonna cover some current events.
Well, thanks, Skylar. And Magdala, thank you for sending us through that. And just so happy to have you a part of our team as we try to keep two certified financial professionals on every single one of our client families. We are blessed to continue to grow. So we needed to expand our team. So really, really excited to work with you and also dive deeper into those two designations that we're offering now. So thanks for going through that. I appreciate it.
I'm happy to be here.
Just to touch on a couple of current events. So this gentleman right here is Kevin Marsh, and we like his last name because all us from Baltimore, we have issues with our R's. So our Baltimore accent really comes out when we say his last name. So we appreciate that. On a serious note, he started and was brought into the chairman position on the Federal Reserve. Technically it was May 22nd, taking over for Jerome Powell. So he has experience at the Federal Reserve before. He was on the Board of Governors from 2006 through 2011. So he's not a stranger or a rookie to the board. Obviously, he is from a chairman standpoint. So he has history of kind of interest rate moves and he's got a ton of economic background for from all the things that he has accomplished in his life so far. So we are constantly getting updates from the Federal Reserve and how the interest rates are going to affect the markets and how the markets are going to affect each and every one of your financial plans. So we are going to stay on top of this, and we're interested in how he could potentially differ from how Jerome Powell ran and headed up the Federal Reserve for 8 years. So it's been a while since we had a new face. So that's this gentleman. We can take his mug off of our screen now with the stop share. All right, so now it's our beautiful faces instead of his. So that is the first current event. The second one is just IPOs in general. SpaceX really captured a ton of attention from probably everyone from the people stocking the Trader Joe's freezers to you all and our clients. So it was on the tip of everybody's tongue talking about how it's going to go public, how the price is going to change, the many, many millionaires that the going public created from the employees and from the early investors of SpaceX. So the next one is probably going to be maybe as popular, maybe not as much as SpaceX, but Anthropic is slated to go public probably towards the end of the year, quarter three or quarter four. So I'm sure we're going to be voicing some opinions on IPOs and how that affects the clients again. So we also had a series on our website that we've started called the Conversation Room. So actually, Skylar and Joe did a entire video on IPOs and how they relate to asset allocation and financial plans. So definitely go to the website and check that out, and you can get a bunch more information and perspective from Skylar and Joe. So, with AI, I'm sure there's going to be other public offerings in the near future. So if you have any questions, how does it relate? Should you participate? All of that, just let us know, and we're happy to have a conversation about that with you all. So, never a dull moment. Never a dull moment.
That's
So,
right.
from here, go to from IPOs to general asset allocation. Kind of Nav has prepared a couple of charts that we can go through just to give you some perspectives about where the markets are now, kind of some of our thoughts on what we should be seeing in the near future. Nav.
Yes. Thank you, Greg. Thank you for the current event synopsis. Lots going on, including inflation numbers that came out today, which pointed to a little bit lower inflation. We say lower, it's not 3.8% like they expect, it's 3.5%. And inflation is still the big driver of pretty much the economy, right? So inflation affects interest rates and affects market movements. So when we look at the stock market in relation to the bond market and in relation to the economy, we always want to think about how does inflation affect things? What's the Fed's mandate? 2% hasn't been that in years, which is why we're seeing the changes we are in the bond market and the in interest rates. So that'll be a fun conversation a little bit later with the professional that's coming on specifically, talk a little bit more about interest rates. But let's start with stocks and the U.S. market and see what's the last 6 months has shown us using this market barometer. So when we look at the year-to-date numbers, so as of 6/30, so the end of the quarter, we have on the left side value stocks, middle is core stocks, growth is on the right, and then far right is if you just own the whole sector, small cap, mid cap, large cap, put them together, this is what you would have returned if you were in one of those sectors. So one of the first things that jump out is there's a really green number here, and it's in the mid cap space. Mid cap growth and mid cap in general has been the best performing U.S. Market cap sector this year at 17, a little over 17%. So that's something we haven't seen in some time where small cap and mid cap stocks have actually outperformed larger cap names. It's been the story has been about large U.S. companies dominating the market, dominating the earnings, and that has still happened. But we're seeing a bit more broadening out of returns throughout various sectors within mid cap and small cap companies. So it's been a good year so far for the markets. Greg, Sky, any insight on what you're seeing based on these numbers?
I mean, I just like seeing the mid cap winning the race right now. I think back to well, not back, but if you're ever watching an Orioles game, here we are in Baltimore, so I'm gonna use the Orioles. The big conversation is ketchup, mustard, and relish, and who's winning the hot dog races. And mustard was really, really far behind at the beginning of the season, which is similar to what mid caps have been doing. So you got to bet on Mustard now because he's been winning the last couple of games. So the point is, you need to stay invested in all the different sectors. switch it up, catch up here and there, maybe relish here and there. But you never know who's going to lead. And mid cap right now is showing very strong numbers. So us maintaining an allocation to mid cap has been is going to be continue to be important as we move forward. So I wanted to mention the hot dog race and I couldn't really figure out where to put it. So
You did good. You did
forgive
good.
me.
I do what I do like about this chart, Nav, is that everything is green, which means that we're positive for the year. And this was not the case just 3 months ago. So we've seen a little bit of a reversal. There were, different fears that were impacting the markets earlier in the year, and so coming through the end of the second quarter is looking a lot better than at where we were at the end of the first quarter here, for sure.
Exactly right. And that's why the importance continues to be staying invested through market cycles, through downturns, because the market historically has bounced back. That happened again this year. So if you were one of the investors that were trying to time the market and you missed that upswing after one of the big down days, because that's usually when the market comes back strong, is after a big down day, then you missed that chance to actually regain some of that the losses. So it's not only regained, we're close to market highs again throughout. But when we broaden it out a bit and talk about the other asset classes, not just in the U.S. market, and we look at this asset class quilt. I know we love showing this chart. We do it most webinars and most meetings. But what we want to just show, briefly talk about, is the year-to-date numbers. So U.S. markets, yes, has been good, but they're not close to being the top returning asset class based on this graph. It's actually emerging market stocks at over 24%, followed by small, and then round out to the bottom, you'll see is fixed income and cash. So when we talk about the other asset classes and we talk about interest rates, reason why fixed income would be so far down is interest rates have actually risen this year versus falling. So when interest rates fall, bond prices rise, and the opposite happens. So when interest rates rise, bond prices fall. So even though there's been a strong interest payment from owning bonds, the price has not gone up. It's gone down for the most part this year. So fixed income and cash, those are the two laggards. And then if you were in asset allocation, 9.3% is what the numbers are showing if you owned all these asset classes together. So a little bit further into the U.S. markets, specifically on, hey, there's a lot of talks about where we are in the markets. We're near all-time highs. What's going on with the price to earnings ratio? What does that mean? So I thought this graph did a good job of looking at not only the top 10, but the remaining companies, and then looking at the S&P as a whole, and then comparing it to the historical average of the price to earnings ratio for those companies. So in the top 10 stocks, they always change. That's one of the realities of being in a country where new companies can come in, make great products, make great earnings, and they're rewarded by being growing in stock price. So the top 10 stocks currently in the US is NVIDIA, Apple, Microsoft, Amazon, Google, Broadcom, Meta, Tesla, Micron, and Berkshire Hathaway. So a lot of these companies 10 years ago were nowhere close to being in the top 10. 20 years ago, some of them weren't even formed. Mm-hmm. So even though this is a historical look back of the top 10, what they've averaged, it's not the same stocks. So that allows us to kind of see, okay, in today's day and age, the top 10 has averaged 20.8%, and currently they're at 21.6 times earnings, and that's 104% above average. So that's not too far compared to when you look at remaining companies as well as S&P 500. Reason being is the top 10 earnings has actually kept up for the most part with the market cap. So earnings over time follows growth. and growth over time follows earnings. And that's what we've actually seen with the top 10 compared to the remaining companies. But we're seeing that broadening out, like we were just saying, with mid cap and small cap companies coming and participating a little bit more in the market returns.
So looking at this chart here on the left, there's a little table in there. It's saying that the latest price to earnings ratio of the top 10 companies in the S&P 500 is 21.6, but the average for over the last 12 months, or is it for the next 12 months, is 20.8. And so it's the 21.6 is about 4% above what the average is. Is that correct?
So it's 4% above the average, and the average is pulled from 1996 all the way to 2026.
Okay.
So that's where the average number comes from. So we're saying basically instead of it being right where it normally would be at 100%, it's 4% above that.
Okay.
Yep.
So yeah, looking back, then it's slightly high. Then it would seem.
Yes.
Yeah.
Right.
So when people ask about concentration and the risk, this is one of the things you can look at and say, okay, well, what is if the top 10 stocks in the S&P 500, what are they doing and how do they compare to what they've done in the past? And we say, hey, it's not that different from where it's been.
Mhm.
And the average of all of the other 490 companies are actually higher than what the top companies are price to earnings ratio. So I'm thinking that these forward earnings are looking really good.
Right. And the forward earnings are based on estimates. So if the companies outperform and beat those earnings, then technically the P would be lower than if if they actually just hit those numbers. So that's what we've seen in the last 3 years when we talk about earnings in general. And the most of that has been driven by AI related industries. So this chart does a good job of breaking down what those industries are. They're hyperscalers, semiconductors, hardware, power, software. So these are the five big industries that really make up and drive AI, which gets broadened out into the rest of the economy. So you can see the return for these different industries going back to 2023 to 2026. That's what these different bars are. And you can see the continued growth of hyperscalers or semiconductors. They were by far the largest grower because they were the initial driver of it. But it's come down a little bit, 46%, still really high. We're seeing some pickup in hardware and power specifically because power is needed to drive all of this. So we're seeing cable manufacturers, anything in the oil and energy, nuclear, solar, all type of energy is needed to power everything. And we're seeing that play out within those industries, actually giving a bigger jolt to the market as a whole due to their contributions. And you can see the industry, the earnings growth, right? So typically when we talk about markets, is future looking. So the 98% that happened in semiconductors growth was very high compared to the earnings initially, but then look at where it is now. So the market anticipated that, hey, we're going to see some serious growth in this industry and rewarded them early. But the companies have actually performed and grown substantially with their earnings. So we'll see how that plays out moving forward. But good chart just explaining a little bit more about what's going on in the AI world.
Yeah, software is hurting.
Yeah.
Software is the one that is down the most this year. And there's a lot of big names in the software space. And part of that is, well, what's AI actually doing to software and how are they going to affect those companies in the future? But the earnings has actually still been pretty steady overall for those companies. But the growth that happened before, right?
Yeah.
So yeah, it's very interesting looking at this. It's good that the market is broadening out a little bit. And that takes us to a little bit of review of value versus growth. So we just went over that chart. Growth has been outperforming, but when we look at where the growth is happening, it's energy and tech, then materials, right? Because materials is needed to build all the data centers and everything and source everything. So those are the three big S&P earnings growth sectors this year. Energy is very much because part of that is because of the oil price increasing, but part of that is because there's just more demand for energy than ever before. So when we look at the price to earnings discount, so value 17.4, long-term average is 14.3. This is going back to 97. Growth is 25.3, long-term average 21.5.
So it's kind of a similar spread
Yep.
to the long-term average for the latest.
Yep. And when we look at the year-to-date performance of the top 50 companies, tech has 33 of them, industrial 7, healthcare 4, energy 4. So interesting market where we're in. Still very dominated by the AI discussion, but AI is no longer just a chatbot. It's AI agents, it's companies that are sending things to cool data centers and making materials for that. So that's actually, from an economy standpoint, is a good thing that we're seeing more benefits to different companies and different industries.
Right. Thanks,
All right.
Nat.
Yeah, thank you.
Absolutely.
Yeah.
So we're going to get into some taxes and planning. I want to remind everybody, if you've not already, please send us a copy of your 2025 tax return. Taking a look at the past year's income tax returns really helps us plan for this year's tax planning. And so if you have not yet completed your tax return and you're going to be getting it done before October 15th, please be sure to send that in to us. It is very helpful in our year-end planning for you. Also, something new on, I guess, planning is that just live on the 4th of July is the new 530A accounts, which every child born from January 1st of 2025 through December 31st of 2028 is going to get a $1,000 deposit in these accounts, which is super helpful for everybody that could use an extra $1,000. It made me think about having another child. I brought it up to Allie. Uh, we're probably not going to go for it, but I'll try. I'll try again soon. So,
Well, you got to be careful because $1,000 versus what does it cost to get a child graduated from college?
hey,
I mean, you got to have some serious growth on that $1,000.
I might be short-sighted, but Matthew Lesko, the free money guy with the question mark suits, I've always been a fan of his.
Right.
So if you have a child or a grandchild that's born in this time frame, you can get an extra $1,000 to their name, which would be great. And I looked it up because I was wondering how many kids were born in 2025, and it was over 3.6 million new Americans. So this is where some of our tax dollars are going.
Right.
Um, but not just the free $1,000 that you can get. You can also get you can contribute up to $5,000 to these accounts per year. There's no tax deduction for the contribution, but your kids don't have to have earned income. So if you're looking for a place to park birthday money or graduation, uh, if you're graduating from kindergarten to first grade or from fifth grade to sixth, and so on. This could be something to add. I don't know that this beats a 529, but it might not be an either or thing. One of the cool things about the accounts, though, that I thought was really neat is that your employer can actually contribute up to $2,500 for it. They get a tax deduction, and you don't pay income tax on the contribution that they made for you. So there's an app, and you can sign up and participate in the tax deferred growth moving forward.
So
One thing
one thing with that, similar Sky, when we saw the investment using the government bonds, the treasuries,
Mhm.
like we utilized a decent amount during COVID, is make sure when you do this, write down your password, write down your username, because if you forget, you're gonna be sitting and waiting on hold for we don't know how long. So you're dealing with the government, it's very large. You have 3.6 million new kids. There are going to be that many accounts. So just make sure you document your information, so then you can access it. You can add money, you can subtract money, you can watch it, you can look at the investments, etc., within that program itself. So.
Yeah, there's going to be at least 3.6 million new customers based on, signing up for to get the $1,000. So definitely make sure you're not in a on a service call trying to take a number in line for sure.
Yeah,
Right.
and this is it's new, and it's never been done before in this country to allow for um, money to be put into essentially an IRA for a child without earned income, and then that can grow and essentially be from 0 to 18, and be specifically for retirement for the most part. We have 529s. 529s are better in terms of just education savings because the growth is tax free, can be used tax free for education expenses, and there is a state tax deduction depending on which state you're in. But the Trump account, the 530A accounts, those are really interesting for and easy to open because it's all online, it's an app, and it's fairly user friendly. So if you have questions, definitely let us know.
Yeah,
Yeah,
I like.
take this opportunity to, if your kids are old enough, take this opportunity to start some finance 101 with them. Hey, by the way, this money is in an account for your benefit. Here's what it means. Here's how you invest. There's additional opportunities, not just the actual money that can accrue in the account and the tax benefits associated with that. But take time with your kids. The sooner the better to teach them how to save, what money is, how it works, how investing works. The doubling, the Rule 72. Just you use this as a reason to open up the conversation with the child or grandchild, um, when you're using this account.
Yeah, so rule of 72 though is sort of a way to estimate how quickly an investment might double based on what the expected return is. And so if you had 72 divided by the percentage of return that you're expecting, then it will tell you how long it might take. So we'll use the rule of 70 to say a 7% return would double in 10 years, um, approximately. And
Right.
so if you happen to have had an investment over the last 10 years that has doubled in value and you go to sell it, you might have what they call as capital gain, which are subject to capital gains taxes. And so the tax deferral offered by those accounts can be helpful because you can buy and sell and not have to pay any tax on that. In taxable investment accounts, we do um, monitor capital gains that are paid from your mutual fund investments. They'll pay out each year in form of distribution. So we review that to see what's the level of gain in the investment itself. Is it greater than the distribution that's paying out? We may make some portfolio changes. That's one of the considerations that we take in your investment accounts, along with the overall investment allocation and your risk profile. And when possible, um, we may sell certain investments at a loss because they can kind of subtract from the gains that you have. And then we switch to sort of alternative investment alternatives for you.
Well,
And
and this kind of comes full circle, Skylar,
yep.
requesting our clients all of your tax returns.
Hmm.
So on the tax return, it's documented what kind of capital loss if you have a carry forward.
Hmm.
So then we use that in consideration to how we're managing the accounts in the current tax year. So just another reason why having your tax return is helpful to us, um, so we can plan accordingly.
And if you happen to have capital gains from either your investment portfolio or the sale of some real estate, a potential way to sort of offset that might be chunking your tax deductions. So if you're otherwise charitable, um, and you're planning on making charitable gifts over the course of several years moving forward, you could make a larger charitable gift in this year, and then use that large gain or large deduction to offset that capital gain, which could be helpful to reduce your tax bill.
Mhm.
We did have a question come through, Nav, about Warren Buffett has made some comments on the market being overvalued and expecting a downturn similar to the tech bubble burst. I think that valuation chart that we were looking at, if you have that handy, we could pull that back up quickly and address the question from our viewer.
Absolutely. Yeah, it's a good question. And the reality is there's been historically the market has dropped on average 14% per year at some point during the year. But every 3 out of 4 years on average, the market ends positive, even with that average intra-year drop. So at some point, we're going to see a decline. We saw some earlier this year. Could we get another one? Of course. The 2000 tech bubble was very unique in a sense of how quickly the market ran up in specific company names, tech names specifically. New internet was a new thing, new infrastructure. And even though a lot of the themes actually played out over time, it took much longer. It took 10, 15, 20 years to really see the investment that was made in the internet companies and play out broadly in the economy. Things are moving much faster this year. And just with the way technology has grown. So we agree that there's always risk and the market is risky and investing is risky, but that's the price we pay for long-term returns. But Sky, to your point with the valuations, the back in 2000s valuations were very high. PE was very, very high. When you look at any of those charts going back, that was one of the highest periods of high valuations. Where here, when we look at it, it's not as overextended in terms of PE multiples.
Yeah, it's like 104% of the average, so it's 4% above what we would typically expect.
Yeah, and the PE for the S&P back then was over 25. So the latest is 20.4, average 16.9. So you could see how wide that would have been even back then compared to now. So we absolutely know that there will be another market correction, whether it's a 10%, 15, or it's a bear market, we won't know. But if you're diversified and not just in single stock or just in U.S. stocks, diversified across different asset classes, that's where you can find protection while staying invested.
Well, and another element to that is the timing, which is why we like to use the bucket approach, where if you have, let's just use Roth IRAs, for example. Most of the time, this would be your most aggressive account because one, it's tax free, the growth is tax free, or tax deferred, and then you can pull it out tax free. But that is also because of that tax treatment, it's usually the last account that we pull income off of to support your lifestyle, right? So even if you have an overvalued market to what Warren Buffett is saying, as long as the stocks are in a longer term account, traditional IRA, Roth IRA for 10 plus years in the future, then you can ride out just like the tech bubble, just like COVID. I mean, how quickly was that recovery in COVID? I think, what was it? March 20th was the
Yep.
was the low. And I don't know if you two remember, but I feel like it was probably mid-April or something that it completely rebounded and got us back to where we were pre-March 20th. So it's just if you have the understanding of this bucket is for this year, this bucket is for years 2 through 5, The next bucket's from year 6 to 10, and then you have your 10 plus year buckets. That's where you take more of the risk. So asset allocation and also time. So
All right. We have Ken Vennick is joining us here with Apex Home Loans.
How are you?
Good
good.
to see you,
Thanks
Ken.
for yeah,
I'm
thanks
glad
for
I got the
joining
blue
us.
shirt memo.
Well, or the blue background. So just wanted to take a quick intro for Ken. I've known Ken. It might actually go 20 years. I feel like I met you at a CPA convention. I feel like for the very
FPA,
first.
or yeah,
It was either, yeah,
yeah,
okay, maybe it was FPA.
could have been.
Um, but it's been such a long time. We've seen each other's careers really escalate, and you have been such a resource to my wife and I personally, and then also our clients that you've helped. I mean, countless amount of our clients, either with education or actually performing the actual loan itself, if it makes sense. And one of the elements that I most appreciate about you is you like giving options. And the clients that know me well on this call or will watch it in the future know that I kind of judge the success that I have with a client is how many options have we provided you for retirement or college or whatever. You do such a great job, Ken, in providing options for financing, whether it's a initial home purchase, whether it's a refinance, whether it's a home equity line of credit. So you being a part of our resource team has been very, very helpful. So thank you for joining us. And I know you have a couple of topics that you wanted to bring to our audience. So thanks for spending some time.
Well, my pleasure. I appreciate the kind words.
Sure.
Yeah, yeah, a couple of things, just where the market is, because everybody wants to know where are the rates and where they go. Um, right now, unfortunately, we're kind of stuck in this mid to upper sixes uh, area. We did touch 599, and then the Iran situation popped up, and so we've been, you know, in the higher six, mid to higher sixes ever since. So I do think that once everything settles down, hopefully it's a quick resolution. That I think the fives are not too far in the distance. We actually got some relatively tame inflation data this morning, which was a good sign. There's a lot more stuff coming out than the rest of the week, but
Right.
obviously anything that happens in the Middle East seems to uh, make the good or bad news uh, a lot less important to the markets. But we'll see what happens there.
Right.
Um, but one thing I added to my title, CMPS, is my certification, Certified Mortgage Planning Specialist, and it differentiates us from most of the competition just because every client's got unique situations. People don't realize it, but what if every a lot of times people call for one thing, and by the time we do some fact finding, there's other underlying situations which may, to your point, maybe a home equity line is the best situation for them. It could be a refinance. So it's really all about getting all the information from the client, finding out the short-term goals, the long-term goals, and figure out what's going to be best for them. When I jumped in, I heard you guys talking about long-term investments. The other piece that we always try to keep in mind, and because we work mainly with financial advisors and their clients, is if somebody's buying a home, do you put 5% down? Do you put 20% down? Do you put 30% down? Well, everybody's situation is different. But if somebody's got to liquidate assets and then have capital gains, tax implications, that 20% down payment could end up being a lot more expensive
Mhm.
versus doing a smaller down payment and paying a little bit of mortgage insurance.
Right.
So those are all the questions that we ask clients and the advisors so we can help them make the right decision. Because a lot of
Hey,
times,
can I add real quick?
yeah,
Not only just from the down payment standpoint, but the length of the term of the loan as well. Go into a little bit of that because that's a big piece of your planning as well.
absolutely. So, you get over from 15 to 30 years. So one thing people want to keep in mind is, hey, getting out of debt is great. There's nothing better than having a free and clear house. But what's the cost of that? So, and this is where you guys come in because you can do all the fancy spreadsheets.
Hmm.
We're looking at if the average return is, let's say, 8% and on an annual basis, and you compare the 30-year loan with that extra money that they have every month to invest, how much will that grow over the next 10, 15 years versus doing a 15 or a 20-year mortgage?
Mhm.
And I'd bet in a lot of the case studies, you'd find that if they did the 30-year, invested the difference, they'll probably have enough money at the end of that 15 or 20-year period to pay off the house and then have some left over. Now, obviously, rates are a factor. It's a much easier conversation in the threes and fours
Yeah.
versus around 7%. So, but that's a conversation I have often with clients is, especially the ones that are the low rates. I mean, don't pay that down. It's like invest that money.
Right.
And then the other piece of that is obviously if you're going to do a longer term loan for that savings, invest the money. If it's just going to get washed into your checking account and just kind of disappear, then do the shorter term loan. So every client's different. Some really have the they can sit there and they know their budget and they're going to make that extra investment every month. So we're all about long term savings for clients.
Yeah, we always try and encourage people to set up automatic investing. So that way it's not the extra decision and this is what we're going to do. It's already done. And then, because yeah, if you don't plan for it and you don't do the extra, oh, I have this extra money. Well, if you're not actually investing it, you're spending it. And so a lot of times
Right.
when we're looking at cash flow projections, our base assumption is, hey, you're going to spend every dollar that we know that you're not saving or paying towards a bill. So, and it's funny sometimes because you could look at the cash flow and I say, all right, well, here's the expenses you told me, and that here's what the year-end savings would have been. Was did your bank account increase by that much? Or were these actually made? And a lot of times it's not. So, focusing on what you're saving and what you can control and investing it is really it can be helpful there. So
Right.
yeah, large
Whether it goes into the kids' education fund, whether it goes into the long term care buckets, whatever it is, right? If it's a bill, like any other bill, it's going to get paid every month.
yeah.
What about a daughter's wedding? Would that be a bucket to save money in, Ken?
Yes, it would be. And I can say that with experience.
Yeah, right. So this is a fun question to ask. Is now a good time to buy? Should I wait for interest rates to go down, or do I pull the trigger now?
I get this question all the time, and my opinion is if it's the right house at the right time, you can afford it, you buy it. We're going to have peaks and valleys. We're not going to have another 2007, 2008. That was part of that problem was 2005, 2006.
Mhm.
Houses aren't supposed to triple in value in 2 years.
Right.
I'll say about this the other day, actually. There's houses now that are valued, but they were in 2007. That's how crazy that market got for that 2 or 3 year period. But the reason why we had that crash after that was it was too quick, it was too high, too fast, and all the bad lending products.
Yeah.
If you could breathe, you got a loan. So the difference is now, right now it's a little more steady. There's still a shortage on housing, and most of the underwriting programs people qualify for. So there's no rise in foreclosures, and so it's the loans out there are much cleaner, much more stable. But to your point of, is it the time to buy? If it makes more sense to buy than rent, I think the answer is yes.
Mm.
Um, Ideally, at some point, rates will come down a bit. I know Kevin Warsh's his goals is lower rates down the road. He's not just going to lower them, or at least lower the Fed funds. I'll get
Mhm.
into that in a second. But I do see that rates will probably come down back into the fives. Will we see the fours again? I doubt it, unless something dramatic happens. But going from mid sixes to mid fives is a big move.
Right.
So if somebody buys a house for 700,000, 800,000, they got a $600,000 mortgage, it's going to save them money if the rates go down 1%.
Oh, yeah.
The problem of waiting is if the rates come down, then more people that were on the fence selling their home will put them on the market. There's going to be more demand of people buying, and then we could be back in that up cycle with more demand for housing, which could raise prices again.
Hmm.
So if you save 1% on the rate, but the prices are 10% higher, where's your payment going to be?
Right.
Hmm.
So at least by buying now, you're locking in the price, you're locking in the mortgage balance.
Mhm.
The only thing you're gambling is that if rates go down, I'm going to save money.
Yeah.
But you got the unknown if you wait.
Sure. Sure.
That doesn't mean somebody should bite off more than they can chew. Still got to be affordable.
Yes, that's the key. And what
Yeah.
what do you recommend clients to keep their debt to income ratio when they're looking at that at?
I'm going to age myself with this. When I got in the business, the ratios were 28-36,
Hmm.
28% on mortgage expense, 36% on all debt. Now we can get people approved with a 50% debt to income ratio.
Wow.
So do I recommend that? No. Is
Mhm.
it doable? Yes. So um, I still like, I would like people to see their debt ratios below 40%. Because when
Mhm.
you really look at the numbers after taxes, and we're not counting gas and electric, cable, cell phones, and all that stuff.
Maintenance.
Yeah.
Childcare.
So yeah. So yeah, I'd like to see people under 40. But we can get them approved higher. Now, sometimes there's other circumstances why there's a higher DTI. There may be somebody else that's going to be living in the property with them that is helping out, that's not on the loan and things like that. But yeah, that's the problem and people come to me and say, what do I qualify for? Like, well, I'm going to qualify you for more than you can afford. So let's take a step back and ask what kind of budget you feel comfortable with.
Yeah.
And then kind of back end re-engineer it from that.
So how does your mindset change when instead of discussing primary homes, what about secondary slash vacation homes that the client wants to use for their purpose? So rental income is not going to cover the expense, or it's not
Mhm.
expected to cover the expense, because I kind of treat that more of a business
Right.
decision, right, rather than a lifestyle. So second home, um, vacation properties, how does your thought process differ?
So, second home is more of a luxury than a need. So, if the budget allows it, you know, some people look at it, they can go on a couple of vacations a year, or they buy a second home,
Mhm.
depending on their lifestyle and how much the vacations cost. Could be close to even. So
Right.
um, I think that typically you're going to want to put more money down, minimum typically 25%, because you put less than 25% down, the rates go up dramatically. Second homes used to be priced the same as primary residences. several years ago, the FHFA, who oversee Fannie and Freddie, changed it where now it's priced similar to investment properties.
Okay.
But I had a conversation this morning with a client who's buying a second home. They already have one. They want to buy a bigger one and then sell the other. But their primary residence was free and clear. So we had the conversation is, does it make sense to leverage your primary,
Right.
do a loan on that, and pay cash for the second home? Could end up being cheaper for them. And that's where we'll typically bring in the CPA to say, tax wise, what's going to work out better for them. So always looking at whatever options we can to get them savings on whatever financing they're looking at.
Sure. Now we have just a couple more minutes. Maybe provide some insights on reverse mortgages and
Sure.
how they could play a part in whether it's the primary clients planning, from our side, us working with multiple generations, or maybe it's the primary client helping a parent deal with a move to assisted living, etc. So a couple of thoughts that you have on reverse mortgages, how they work, how you see them in a positive way, maybe how you see them in a negative way.
Okay. Yeah, reverse is one of those things where a lot of people have strong opinions both ways. In my opinion, it can be a great tool. It could be a great program. It could be a terrible program. All depends on what the plans are with the house. So a typical conversation is, what's the plan? Is there heirs? Do they want the house? If there's no heirs, what are you going to do with the house? And if the house is not a big issue in the family long term, it's an asset. Utilize it. The last thing you want to do is be spending down your liquid assets too quickly, because if you've got $500,000 invested, that goes to 400, then to 300. I mean, you're losing ground. But if you can utilize the equity in your home to either pay monthly expenses or create a monthly income, and they work in three ways. You can have a line of credit open that you can draw at any time if needed. You can set up basically almost like an annuity where you're getting a monthly check every month to help. Or you can get a lump sum and just pay off the mortgage or whatever you have on it. Most of the ones I see are the line of credit, and they draw on it as needed. One thing that a lot of people don't know about the reverse mortgage, and this is where it really becomes planning tool, is for folks that maybe are 70 years old, still working, but they know they're going to be retiring in the next 5 or so years. Free and clear house. But they know they're going to, they want to have some other available money down the road. Maybe it's a $800,000 house free and clear. Let's say they qualify for $250,000 on a reverse. If they don't touch that loan for 5 years, that line of credit, every year that line of credit grows by the interest rate of the reverse mortgage. So let's just say it's 7%. So each year it's going to grow by 7%. So don't have my calculator in front of me, but that 250 could then be 3.25 or 350 by the time they need to draw into it. So that's another way because you can't borrow a large percentage of your equity unless you're extremely old.
Right.
So it's another way, if people start earlier than later, they can really grow how much they can tap into the equity of the property.
And it's not a distribution from an IRA that's taxable. You're not reducing your portfolio value, which then affects your like ongoing compounding. And you still participate in the price appreciation of the house as
Right.
well. Because if you were to sell the house, you'd need to find somewhere to live for one, but also, depending on the level of gain that you have in it, uh, could be looking at some income taxes as well.
Right. Now, on the flip side, I give you some of the negatives and I gave you some of the positives. It's more costly than a regular home equity line. The big cost is the FHA insurance, which is 2% of the market value. That's the big difference between that and a traditional home equity line. Other than that, it's just traditional closing costs.
Mhm.
So the upfront costs, but that can be also rolled into the reverse. So clients don't have to come up with that. But and then the only other negative is if you want somebody in the family, to keep the house, or somebody in the family wants to keep it, they're going to have to refinance that loan. So depending on how long you're going to live, you don't know what that balance is going to be when you pass. So in a perfect scenario, it's for folks that don't care about the house when they're gone, and there's no liability to the estate. If they're upside down, they won and the bank lost.
Mhm. Yeah, huge.
Make your last check bounce, kind of a thing.
I talked to a referral the other day, and he said, yeah, his goal is to use up the last piece of his equity on his last days. And he
Mhm.
not married, doesn't have any kids, and he's got he has that $800,000 house. He's got a mortgage on it, but we even talked about how to he's selling another rental. He may pay off that 200,000 and then use that as a tool to grow that line for him.
Right.
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 So reverse mortgage is definitely an arrow to kind of keep in the quiver for, if it makes sense, but it's not
Right.
the end
Not a
all
one
answer.
size fits all, but it's
Yeah.
certainly a
Definitely.
great
Yep,
tool for the right situation.
exactly.
Right.
It's a tool, and we like tools.
Yep.
Well, Ken, thank you very much. It's been very insightful. And I appreciate you joining the call here.
I
We're
appreciate
at
the invite.
we're at our time here. And so what I like to do is thank everybody that has been able to attend. And uh, I wanted to give a plug. Greg already had given us a plug here earlier about our Conversation Room podcast. If you would like to get a recap of this webinar, please go to armstrongdixon.com and subscribe to our blogs. That's there. You can also see our latest conversation room where Joe Breslin and myself are decoding IPOs.
Hmm.
So thank you very much, everybody, for attending. I really appreciate you joining us, and we will see you next time.
Thank you,
You
Skylar.
all.
Thanks, Greg. Thanks, Ken.
You
Yes.
too.
Have a good day.